So-called safety stocks like the utilities and the real estate investment trusts are hitting new highs, and it could be a bullish sign for the bond market of all things. Find out why. Welcome to Trading Nation. Dennis Davitt and Larry McDonald, your Trading Nation team today. Dennis, a little surprising, I guess, that these stocks are going up, considering that interest rates are expected to go up, which should hurt these names. You think this is just a short-term swing, or is there a real opportunity in REITs and utilities?
I think there's a real opportunity in REITs and utilities because I think the bond market is causing them to appreciate in value. But the one thing we need to look at in REITs and more so utilities is the amount of deregulation that's come into the market. So as they deregulate the markets more and more on the utility side, which has been done with a good amount of the executive orders that have come down, it does open up opportunities for these utilities to be more than a safety stock, to maybe start justifying their, what I think are slightly elevated PEs, but because they could have some pricing power back into what they sell.
Yeah, what's your take on this, Larry? I mean, it's a little bit of a surprise. Listen, REITs are different because there's been all this retail pain, and so the REITs are going to do maybe more what the real estate industry, that's why there's the real estate in their name. Utilities, a different story. Should we read it the same way? How do we look at this?
Well, historically, what I like to do with the REIT sector, especially the utility sector, is wait for bonds to really sell off and you have a really spike in yields. And what that forces, and we saw this in December when everybody got all pumped up on the reflation trade, that forces a capitulation in REITs and utilities. And we've had that opportunity in the last couple of years, a couple of times. I'm really concerned about global growth. There's $62 trillion of GDP outside the United States. Global GDP for the first time is being upgraded by the IMF, and that's now feeding back to the U.S. So the global growth picture, along with tax cuts and fiscal policy from Irma money and Harvey money, as well as Maria money, all these things are coming together in the fourth quarter. And into next year, I think we're going to get a spike in yields. It's going to surprise people. That's going to hurt REITs. It's going to hurt utilities. I'd stay away and wait for a better spot. Really, you want to wait for your capitulation moment in those two sectors. In
this market, I don't know. Are we going to get a capitulation moment on anything, guys? I mean, Dennis, I'm making kind of a tongue-in-cheek statement. Is there any sign? I mean, right? Would somebody tweet me today that not making a record high is a new bear market? I mean, obviously they were kidding, but they get their drift.
I mean, there's been so many. Finance is an industry where if you're really wrong, you usually get taken out. But people have been waiting on the sidelines to buy this rally in whatever asset class it is, and inflation is not come around. I would hope inflation would come around. We're seeing an equity rally that you would get in times of inflation, but we're not seeing wage pressures go higher. The global economy is heating up, but I put a lot more weight into what's going on in the actual market than what the IMF is saying.
Okay, that's probably another discussion, guys, but still one that we need to have. We're watching utilities, watching REITs, watching rates, pretty much watching everything. And by the way, we're watching everything still pretty much go up almost every single day. Larry and Dennis, thank you both very much. Check out the live version of Trading Nation on Power Lunch every day. I'll see you there as well. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.